Good afternoon, and thanks for attending today's Super 101 webinar. We'll give everyone a few moments to join the webinar, and I'll commence shortly. Great. My name's Clive. I'm a member account specialist with Brighter Super. An important part of my role is guiding our valued members towards a comfortable retirement. By the end of today's webinar, we aim to give you some useful information on the basics of superannuation. I'm joined today by one of our member account managers, Peter Hoban, who will be monitoring your questions in the chat today. Brighter Super acknowledges the traditional owners of the lands we meet on today, and we pay our respect to elders, past and present. We're proud to serve Queensland's 17 Indigenous councils, and we strive to provide positive outcomes for our members who identify as Aboriginal and/or Torres Straits Islander. It's important to understand that the information and examples contained in the webinar are general in nature and are being prepared without taking into account your individual objectives, financial situation, or needs. It's important when making decisions about your super options that you obtain the relevant product disclosure statement and target market determination and consider your own personal circumstances. You can access these documents and the privacy policy and financial services guide from the Brighter Super website. Today's presentation will run for about 30 minutes. Many of you have submitted questions already, which we've tried to incorporate into the presentation. You can also post questions in the Q&A feature during our presentation today, which you'll aim to answer directly. We have Peter Hoban standing by as a moderator. Peter is we have worked together for a number of years, and when he's not helping me in moderating, he's out helping his members as a member account manager, giving great personal service throughout Queensland.
Thanks, Clive. A lot of good information in this webinar today. If you do have any questions, please put them in the Q&A box. I'll do my best to answer them. If we're not able to get to them today, we'll definitely be getting in contact with everyone to give them those personal answers. Thanks, Clive.
Pleasure. Great. Thanks for joining us, Pete. Before we move into our main subject, I'd like to take the opportunity to briefly explain who we are, as we have had some non-members joining us today. The merger between LGIA Super and Energy Super, plus the acquisition of Suncorp Super, has enabled us to increase our size and scale, and yet we remain committed to investing in the personalised member services that you know and enjoy. We serve over 280,000 members with more than $34 billion in funds under management, and we received double-digit returns for the balanced accumulation and balanced pension options in the full year for 2024. Now let's talk superannuation. The purpose of super is to preserve savings to deliver income for a dignified retirement. Now, most of us make our contributions during the year, but we don't think about how much we need as we get closer to retirement. So let's review what superannuation is and how it works. Super's linked to your employment. Your employer contributes money into an account on your behalf. Your money is then invested. Any fees and insurance premiums are deducted, and what remains is your benefit. Superannuation is a long-term investment, so making good decisions early is essential, and the earlier you start, the better. There are benefits of contributing extra to your super. The money your employer is putting into super for you is a great start, but by adding a bit more, you can make a huge difference to your retirement balance. And now is just the time to start to think about your super, even if it feels a long way off. Compounding returns makes a difference. You don't need to add a lot to have an impact. Salary sacrificing is a common example of additional contributions, and we will discuss this later in the presentation. there are some important points to consider before deciding whether to add extra funds into your super. With all contribution types, there are contribution caps to be mindful of. Depending on your level of income, some types of contributions may be more or less tax effective, so you should carefully consider which is right for you. You should review your budget to ensure you can support the reduction in take-home pay. Any additional contributions you make also form part of your reserved amount, which you cannot access until you meet a condition of release, generally retirement. So now that we know what superannuation is, we need to talk about the contribution options. There are two main types of super contributions: concessional, or before tax, and non-concessional, also known as after tax. Both have limits or caps. The concessional contributions cap for the current financial year is $30,000. Concessional contributions are made from pre-tax money and include employer contributions, salary sacrifice, whether mandated or voluntary, tax-deductible personal contributions. If you exceed the concessional contribution cap, there may be additional tax to pay. Non-concessional contributions come from funds that you've already paid tax on. That is why these contributions are also known as after tax. Under current rules, you can potentially contribute up to $120,000 per financial year as non-concessional contributions. If you're under the age of 75, you may potentially bring forward up to 3 years worth of contributions, so up to $360,000, depending on your total super balance. If you're considering making extra contributions to your super, please consider seeking advice. Later in the presentation, we will discuss how we can help you with this. On the previous slide, we discussed the concessional cap of $30,000. To grow your super, some members may be able to use what is called the carry forward rule, which may allow you to access any unused concessional caps from previous years. For example, if last year you contributed $20,000 of your concessional contributions cap, this year you may be able to add a further $10,000. Therefore, in this example, a member may be able to contribute $40,000. You must have a total super balance that is under $500,000 at the end of the previous financial year. Members may have up to 5 years to use any unused concessional amounts. Remember, concessional contributions may include salary sacrifice or tax-deductible contributions. It's important to seek tax advice to ensure that it's beneficial to your circumstances. You can find out your personal unused concessional contributions through MyGov, through the ATO portal, under the tab Superannuation. Let's now discuss salary sacrifice. Australia has a tiered personal taxation system, which means we get taxed at a progressively higher rate the more we earn. For this example, we will look at someone earning between $45,001 and $135,000. Their overall marginal tax will be 30% plus the Medicare levy of 2% if applicable. If you're earning over $135,000, the tax rate may be even higher. Let's apply this to superannuation contributions. An after-tax contribution simply means that income tax has already been deducted from the money before it's contributed to super. There's no tax on entry to the fund because it has already been taxed before you contributed it to super. However, if your employer allows you to salary sacrifice, or if you claim a tax deduction on an after-tax contribution, these contributions are taxed at 15%, which is a concessional tax rate and is why these are known as concessional contributions. This generally means for those earning between $45,001 and $135,000, You may pay less tax on the before-tax super contributions than you would on after-tax contributions. A reminder that the contribution tax still apply, which is $30,000 this financial year. Now, before we move to an example, let's go and ask the first poll question. Do you salary sacrifice? Yes or no? That's great to see. Most of you are salary sacrificing and making the most of these benefits. For those who don't, remember, always come and have a chat to us. But let's look at an example now. Let's assume this member is contributing $5,000 to their super and they earn between $45,000 and $135,000. If they make an after-tax contribution, the tax paid would be $1,500. If their employer allows them to salary sacrifice, or if they claim a tax deduction, they would be saving around $750 per year based on the difference in tax rates. It can potentially be a great way to boost your retirement savings. Meet Tina. Tina has recently turned 45 and is in a position to make extra contributions to her super. The following calculations have been made using our own retirement income calculator and our salary sacrifice calculator. She's looking at making some salary sacrifice contributions. In option A, if Tina chooses not to contribute, she may retire with a balance of $416,000. However, in option B, if Tina contributes $100 a week over 15 years, she could potentially grow her super to just over $500,000. Because she's making this as a salary sacrifice contribution, the tax benefit means that her take-home pay only reduces by $68 a week. Think about that. That's an extra $85,000 in retirement. As you can see, small changes over a point in time can make a big difference. Please note that this does not consider market volatility. At Brighter Super, we are here to help you. Our website contains a range of resources, including our salary sacrifice calculator, which we used on the previous slide in Tina's case study. It allows you to find out how you can maximize your super by contributing more and or after tax. You can find this and other calculators under our resources tab, and it takes about 10 minutes to complete. It also gives you the option to see if you can afford to contribute more by reducing your take-home pay. There may be another way to contribute. This is called spouse contributions. So, what's a spousal contribution? If you contribute to your partner's super account and they have a total annual income of less than $37,000 a year, you will receive an 18% tax offset on the first $3,000 of contributions up to a maximum of $540. The offset gradually reduces for income above this level and completely phases out when your spouse's total annual income reaches $40,000. This is a tax offset, not a tax deduction. The contribution will be treated as a non-concessional contribution for your spouse. The contribution must come from your after-tax income. This is paid directly into your spouse's super. This may be beneficial if you or your spouse have a career break or one earns less or is not working. The government co-contribution may be another type of contribution to consider. This payment is to help boost your retirement savings. If you are a low or middle income earner and make voluntary after-tax super contributions, you could receive a co-contribution from the Australian government of up to $500. If you have a total annual income of less than $45,400 this financial year, the Australian government will contribute 50 cents for every dollar you put into your super, up to a maximum of $500 in a financial year. The super co-contribution amount gradually lessens as income increases until it caps out for those who earn $60,400 or more. To receive the maximum co-contribution of $500, you need to earn $45,400 or less and contribute at least $1,000 to your super. This could be beneficial for those entering the workforce on a part-time basis to grow their super and receive a benefit from the government at the same time. Like anything, rules and eligibility criteria apply. So for more information, please visit our website or reach out to us. On our website, under forms and info sheets, you will find information on all contributions we've covered, plus other contribution types that may be available. Once you have the money in super, then you want it to grow, so it will sustain you throughout your retirement. The reason why investing produces a return is because there's a risk involved. If you give somebody $1 and expect them to pay you $1.20 back next year, there is a risk you won't get your money back. This is the key to investing, understanding that risk. Brighter Super's aim is to grow our members' super balances while providing consistent returns. That means we want your investment to grow when markets are performing strongly and reduce the impact when markets start to fall. We place great value on diversification, which means not having all your eggs in one basket. To achieve this, we offer ready-made investment options which spread your money across a number of different asset classes to reduce the level of risk. Each of our ready-made investment options offer the benefits of our strategically chosen investments. Depending on what stage of your working life you're at, what your retirement goals are, and how long you've got before you retire, you may want to take more or less risk, and we have options for you. We're going to talk a bit about this over the next few slides. Some people think of their super as a single asset, but it can potentially be invested in many different assets. Most super funds offer different types of investment choices to their members. Investment choice is selecting which asset class you're invested in, such as Australian shares, international shares, fixed interest, cash, or property. Investment options offered by super funds can either be diversified, which is investing in a mix of different asset classes, or single sector options, such as investing in just one asset class. Diversification can be achieved by choosing a ready-made diversified option, such as a growth or balanced option, or by choosing a mix of single sector options, choosing your own mix of different asset classes rather than a ready-made mix. Now, on to our next poll question. Do you know which investment option you are in? Yes or no? Excellent. So again, it seems like most of you are aware of what the option you're in. Remember, reach out and let's find out and see if we can help with helping you decide what's best for you. Assets such as equities, otherwise known as shares, are described as growth assets. These may see volatility over the short term. The value may go up and down, but over longer time periods, they generally experience higher growth. Asset classes like cash and fixed interest are sometimes described as defensive options. They carry less risk in terms of volatility of returns and potential for capital loss, but they also offer less potential for high returns. These options are generally described as low risk, low return. Now, Brighter Super offers 12 investment options, a combination of ready-made, diversified options, and single sector asset classes. If you don't select an investment option, you will be invested in the default option, which is called My Super. Often when I'm talking to people about investment choice, I'm asked the question, what is the best way to invest my super? And as you could probably imagine, there's not one single investment option or profile that would be a fit for everyone. In fact, there are a number of different things to consider when choosing the right profile for you. So what is a risk profile, you may ask? A risk profile is an individual measure of how you feel about risk and return, keeping in mind that there is always a trade-off between these two. It takes into account your tolerance to market falls, as well as your investment time frame and desired return outcomes. For example, an aggressive investment is expected to generate a higher rate of return over the long term. However, it is likely to fluctuate more in value. What this means is that your investments may grow faster over time. However, it will generally lose more when the market dips and produce more frequent negative return years. A more conservative investment, on the other hand, is likely to have fewer negative return years overall and may not drop as far as an aggressive investment during a downturn. However, the trade-off for less downside risk is that the positive returns are expected to be lower over the long term. Understanding your risk profile and your investments risk is important to help better prepare for market movements and make informed decisions. Being invested outside your risk profile is a risk itself. If you're invested too conservatively, that risk may be missing out on potential returns that you could have. If you invest too aggressively, you may see greater falls during market instability than you're comfortable with. Both of these scenarios do not result in an optimum outcome, so it is important that you know where you sit. You can find the investment risk profiler on our website under the resources tab. Now, what else do you need to consider within your superannuation? Within super, you may have death and terminal illness insurance, total and permanent disability insurance, and income protection. These are very important insurances as they ensure that your loved ones are taken care of if you can no longer take care of them. Often, this may be a tax-efficient way to take out insurance. Your employer's superannuation contributions and salary sacrifice contributions are taxed at 15%. This is lower than the marginal rate for most people. This can make paying for insurance through super tax effective. It's important to only insure what you need and the right level of cover, so you're not paying more premiums than necessary. As mentioned, there are 3 types of insurance you can include within your super: death and terminal illness, TPD, and income protection. Death and terminal illness cover provides your loved ones with a lump sum if you were to pass away. This means that they don't have to worry about money during what will already be a tough time. Total and permanent disability, also known as TPD, pays you a lump sum if you suffer from injury or illness, whereas income protection pays you an income if you're injured or otherwise unable to work. These are important insurances, but you need to make sure you have the right cover. We've covered a lot today, but one last thing we want to highlight is who your super goes to in the event of your passing. Super funds can generally only pay to a dependent or your estate. Dependents are a spouse, child or children, financial dependent, or someone you share an interdependent relationship with. There are a couple of beneficiary nominations on the screen, but one I want to call out is a binding nomination. A binding nomination legally binds Brighter Super to pay your death benefits to your nominated beneficiary or beneficiaries. We have recently improved our services, and you can now nominate a binding non-lapsing nomination online. One last thing to consider, make sure you go home and check your current nomination, which can be found on Member Online or on your annual statement. It's important to review this regularly. We understand that this can be a complex issue, and we have a dedicated beneficiary webinar, which takes place regularly, with the next one taking place soon. Please visit our seminar page to register. So, what are some actions you can do today to make sure your super is on track? It may be worth considering to consolidate your accounts, but what does this mean? It means bringing multiple accounts into one. There are a few reasons why this may be a good idea. Firstly, if you have accounts with multiple super funds, you may be paying multiple sets of fees, and so consolidating your funds may save you money. Having all of your super in one place can also reduce your paperwork and make it easier to track. There may also be reasons to retain multiple accounts, and consolidation may not be right for you. Before consolidating, ensure you review any insurance or investment arrangements to make an informed decision. You may lose insurance, so it is best to check first before consolidating. If in doubt, seek advice. Before we move to the Q&A section of the webinar, let's summarize some further actions you may wish to take. Consider if you need to have duplicate accounts. You may be paying two sets of fees and insurances. Now, not all of us know where we have a duplicate accounts, but if you have had a lot of jobs, you could have a lot of accounts. Also, look into the balance. If you think there isn't as much as you thought you should have, you might have another account. You can also book in for a super health check with us. There's no additional cost for this, and it is open to non-members too. I'll explain shortly how to do this. Make sure you've registered for Member Online. From here, you can manage your super online and update things like death benefits, investments, update details, and consolidate accounts. Another action is to consider advice. Today, we've talked about the importance of getting advice several times. I'll go through our different range of advice offerings in the next few slides. What makes Brighter Super different to other superannuation funds? It's our commitment to personal service. We have a dedicated team of member account specialists here to help you. If you'd like to talk to one of our staff one-on-one for more general information about your superannuation, why not book in for a super health check? A super health check covers a variety of areas such as contributions, insurance, and beneficiaries. If you'd like to book now, there is a QR code on screen. You'll also receive a link to book a super health check in the coming days, alongside today's webinar recordings. Our team services members through both face-to-face and also digital channels, so you can get some general advice on a range of superannuation topics, no matter where you live or work. We offer a range of personal advice options suited to individual member needs. If you're looking for a specific information about making contributions or investment strategies, our intra-fund advice team can help. Book in an over-the-phone meeting with a financial advisor at no additional cost. We also offer a range of paid financial advice services such as retirement health check, scaled advice, and comprehensive advice, which you can see on your screen. The cost will depend on the complexity of the advice, and this cost may be deducted from your Brighter Super account. For more information on our range of services, please visit our advice tab on the Brighter Super website. Similar to today's Super 101 webinar, our seminar page includes a range of upcoming webinar topics. Keep an eye on this page as we update it regularly. On the previous two slides, we discussed our range of advice services. These cover our super health checks and intra-fund advice, both of which there are no additional cost to our members. To other types of advice, such as retirement health checks, scaled and comprehensive advice, our next poll question for you is, after today's webinar, are you planning to get advice? Yes or no? Excellent. Excellent. We look forward to helping you with those, finding more about your super. I've covered a lot of ground today, so remember you can also visit the resources tab for calculators and forms and info sheets for more information on what we have discussed. We have tried to answer questions throughout the webinar today, but I'll invite Pete back on screen to answer any questions we couldn't get to in the Q&A chat. During the Q&A, we will revert back to the Super Health Chat slide to give you all additional time should you wish to book in an appointment.
Excellent. Thanks, Clive. So there were no questions actually asked during the presentation, so I think you've done a great job of explaining it there if nobody's needed that clarification. We did have some questions submitted prior to the presentation, and most of those we were actually able to weave into the presentation and answer there. So no questions right now. Anyone who did pre-submit a question and we haven't answered that, rest assured we'll actually be getting in touch with you to provide an answer directly to you. So Clive, great job. You explained everything really well.
Thanks, Peter. Really appreciate your support today, man. Okay. Excellent. So thanks again for taking time to come and join us and coming along and attending the webinar. Though, one last poll question before we bring things to a close. Overall, how satisfied were you with today's webinar? Very satisfied? Satisfied? Neither satisfied or dissatisfied? Dissatisfied and very dissatisfied. Excellent. Thanks very much for attending today's webinar, and we hope to speak with you soon.